Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 17th of January. I'm Daniel Lam, your host for the podcast. Further to what we talked about yesterday, the Hang Seng Index did break below the key support level at 15,972 as investors continue to express their doubts about the Chinese economy. Now, interestingly enough, we're getting questions from our clients as to the read-through to the European markets, because China has been the top destination of European exports in 2020 and 2021, and a close second to the US in 2022. Naturally, such developments in China would be negative for the European economy, which is already likely in recession, having contracted in the third quarter of 2023. The latest business confidence indicators, i.e. the PMIs, show service sector activity has been contracting since August, while the manufacturing sector remains depressed. The ECB's record policy tightening has led to tighter lending standards. Structurally, the higher energy cost after the 2022 sanction on Russia and a tight job market are keeping inflation elevated. However, European equities have been strong in the last quarter of last year because the soft landing narrative in the US has been filtering through to European assets as well. The investors see a recession in Europe to drag inflation lower, enabling the ECB to cut rates by 75 bips in 2024. But this Goldilocks scenario seems to be, quote-unquote, pushing it somewhat, because growth has been weaker and inflation appears to be more stubborn in Europe versus the US. And this is reflected in the Euro Stoxx 50 equity index chart. It is making lower highs and lower lows very close to its peak since the global financial crisis. The relative strength indicator, i.e. the RSI, is losing strength. Momentum indicators such as MACD and ADX are both beginning to dip into the bearish territory. Now, granted, European equities are trading cheap versus the US. For example, it is at 12 times 12-month forward PE versus the 20 times in S&P 500. Versus global equities, European equities are at a 25% discount versus a historical average discount at 12%. But we do believe that this deep discount fairly reflects the region's relatively lackluster economic profile. So all in all, the risk-reward is not so favorable in chasing European equities higher at these levels. Now, if there were to be consolidation in global equities, it would be preferable to buy the dips in US equities and in Japan equities because of the stronger growth inflation dynamics in the US and the improving corporate governance in companies and economic outlook in Japan. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.